If you're an e-commerce seller, there's a good chance you've heard of the sales tax Nexus, but there's also a good chance you have no idea what it is. And that's completely normal. Sales tax can be very confusing, but the laws surrounding it can be pretty strict as well. So I want to break it down for you step by step so you don't have to come across any issues in the future. My name is Arthur. I'm a certified advanced pro advisor in QuickBooks Online and owner of S&G Bookkeeping, an exclusively e-commerce bookkeeping and accounting firm that works with 6 and 7-figure brand owners in order to optimize their accounting and bookkeeping solutions. Over nearly the past year, we've dealt a lot with sales tax for our clients. So we know a thing or two when it comes to sales tax, and we want to pass on that knowledge to you. So to get started, what does a nexus even mean? A nexus basically just means a connection to a state. In the context of sales tax, it means the seller's connection to a state and their obligation to collect and remit sales tax that they collect from their customers. In this video, we're specifically going to be talking about sales tax in the US because we work primarily with US-based clients, and most of the people watching this are also in the US, but you should be aware that sales tax can be in effect in almost all parts of the world. I think it's super important to understand how sales tax actually works in order to give you a better idea of this nexus. So the way that sales tax works is, I'll just give you an example. Let's say I'm a California seller and you're one of my customers in Chicago, Illinois. If I sell you a $100 pair of shoes, it doesn't really matter, just for an example, and let's say you pay me 10% sales tax on that purchase. Now that 10% can vary county to county, state to state, city to city. There's over 11,000 tax jurisdictions in the US, but let's just call it an easy 10%. So you pay me an additional $10 for Illinois sales tax. As the vendor, as the business owner, what that looks like for me is $100 of revenue for my business, and then an additional $10 liability that I would eventually have to pay the Illinois Department of Revenue every month, quarter, or year, depending on my filing frequency. And this filing frequency is determined by the volume of transactions that you have in that specific state. So if you have many transactions in Illinois, for example, then it's more likely than not that you'll be doing monthly sales tax remittance. Now, just to clarify, whenever I'm saying remittance, all that means is actually paying that correct state government, that correct Department of Revenue, any sales tax that customers from that state paid them. So just basically paying the state their tax revenue.